Continuing Kevin's journey, we now move to his third transaction. On March 10, Kevin borrowed $2,000 from a bank due to the need to purchase supplies for the business. Earlier, it was discussed that the borrowed money or loan increases Kevin's cash, thus increasing the assets, but it also increases the liability. So how do we journalize Kevin's transaction? Here it is. First is we put on the date of the transaction, which is March 10. After putting the date, can you guess what should be debited on this transaction?
Oh!
Without question, since Kevin borrowed money, the cash account undoubtedly increases. Cash is then debited since this account's normal balance is debit. Then, place the amount borrowed on the debit column. Next is to know what account to be credited. When Kevin borrowed money, that also means he has the obligation to return the cash for a certain period of time, thus increasing Kevin's liability. But what account under liability is increased? The account suitable for this transaction is called loans payable. The loans payable account means that there is an amount owed to the creditor, and the creditor in Kevin's case is the bank. Kevin is now in debt to the bank because of the money he borrowed. Because of this debt, Kevin is liable to pay the bank in the future. To increase the loans payable account, it must be credited because its normal balance is credit. Then, put the amount on the credit side, which is the $2,000 borrowed from the bank. After debiting and crediting the accounts related to this transaction, we now explain briefly what transaction took place, which is to record the loan from a bank. On March 25, Kevin now has enough cash to purchase supplies. He went to a supplier and purchased supplies worth $400 revenue. The account suitable for this transaction is supplies, or we can specify it as laundry supplies, since Kevin is running a laundry business. Laundry supplies is part of the asset, and that also means that its normal balance is debit. So debiting this account would definitely increase it. Then, Kevin must decrease cash because he used it to purchase the supplies. The cash account should be credited when decreasing its amount. After debiting and crediting, we can now explain the transaction. You should have noticed that laundry supplies and cash are both part of the asset, just like the March 3 transaction. The total amount of assets is unaffected in this transaction. Yes, you heard it right. The total amount of assets in this transaction is unaffected. You might be wondering why the total amount of assets remains the same even after the transaction. It is because one asset, which is the laundry supplies, is increased. At the same time, the other asset, the cash account, decreased due to this transaction. Let's try to reduce or hopefully wipe your confusion out. You can't possibly forget about the accounting equation, right? Asset is equal to liabilities plus equity. What about it? Well, we'll try to check and balance the accounting equation using the journal entries of Kevin. The investment of Kevin on March 1 consists of cash and Kevin Phillips' capital. Cash is on the debit side, which means it should be increased under assets. Next is Kevin Phillips' capital, which is credited and is under the equity. The accounting equation is balanced, and both sides have a $6,000 balance. Proceeding to March 3 transaction, laundry equipment is increased because it was debited. At the same time, cash is decreased. Cash is decreased because its normal balance is supposed to be on the debit side. It was only reduced because it was used to purchase the laundry equipment. Thus, it was credited. When we try to see the balance of each accounting elements, it remains unchanged even after the March 3 transaction. Look, the laundry equipment and the cash are both part of the asset. One has increased while the other decreased at the same time, and both have the same amount. And that is why the total amount of the asset remains unaffected. On March 10, cash is debited, which means asset is increased. As for the loans payable account that is credited, liability is increased since it has a credit normal balance. Lastly is the March 25 transaction. This transaction has the same concept as the March 3 transaction. Both accounts are assets, but the total amount of assets was unaffected with this transaction. Adding all the increases and deducting all the decreases in each accounting element, you can notice that $8,000 is equal to $2,000 plus $6,000. Adding the liabilities and equity would equal to $8,000, which is the same amount as the assets. Isn't it amazing?
Wow!
Assets equal the liabilities and equity.
Hi, I'm Abigail. I don't really have an accounting background. I hope you can help me record the transactions.
What's this? Looks like someone needs help.